You're live.
Hi, you're watching BloombergQuint. Now, last week marked an interesting shift in the internal view at RBI on corporate entry into banking, including for the conversion of large NBFCs owned by business groups. It's still only a working group paper, so let's not get ahead of ourselves. Yet, it is an important discussion point, and hence joining me on Talking Point this morning is Rashesh Shah, the chairman of Edelweiss Group, to share his views on this working paper and its recommendations, and of course to also throw some light on the economy. Good morning, Rashesh. Thanks very much for joining us.
Hi, Menka. Good morning.
Rashesh, quickly, just couple of the bullet points to remind our viewers of the key takeaways from that working group paper. A, that large corporate industrial houses may be allowed as promoters of banks. B, that large NBFCs with assets of above 50,000 crore rupees, including if these NBFCs are owned by large corporate houses, may be allowed to convert to private banks. That payment banks can convert to small finance banks in a shorter timeline, so 3 years versus 5, and that the NOHFC structure is mandatory only if the promoter group owns other group entities. These are the key 3-4 takeaways. There are plenty more. It's an over 100-page report. But let me get your thought on the very first, most important central thought to this, which is that, allowing for both the business houses to get into banking, as well as maybe even their NBFCs, or other NBFCs owned to convert. Do you see, if this were to become reality, a long line for private bank licenses?
So if you go back and see, Menka, 25 years ago, when the first set of private banks were allowed, there was no restriction on corporate houses promoting banks. So I think in a way it's a good thing for 4-5 reasons. I think a lot of them you have enumerated, but just to put it in context, I think overall we do need a lot more banks. And banks, I think starting a bank is also very capital intensive. And if you don't allow corporate houses, then where will the capital come from? It won't come from only international investors or PE investors, because there are caps also on what foreigners can own in the banking arena. So I think one is large corporate houses can bring capital, can bring the long-term, creating of an institution in India. Other, as you said, if they already have large NBFCs, more than say 50,000 crores of assets, they're anyway interconnected to the banking system, because a lot of them would be borrowing from the banks, would be borrowing from the markets, from the retail investors. So I think the time has come to revisit that. I think the working group has done a good job of highlighting that. I think there's still a lot of clarity required on NOHFC and other things and all. But I think in principle, most of the recommendations of the working group are very good. India needs a lot more banks. We need a lot more banking penetration, and banking needs capital, because for every 100 rupees of loan that a bank gives, a bank needs about 10 to 15 rupees of equity capital. And this is really long-term equity capital. So India has always faced a shortage of that, of where does the long-term equity capital come from. So I think corporate houses will bring that. Also, I think we should keep in mind that the crisis of the last 2-3 years in the NBFC sector has shown that larger NBFCs, as you become larger and larger, there is a rollover required, because an average NBFC's borrowing tenure is about 3 years. So if you are an NBFC with say 1 lakh crores of assets, you have to borrow 35,000 crores a year just to roll over your debt. And that can create even larger, systemic risk. So in any case, I think large NBFCs either needed some backstop or access to customer deposits, and needed a much stronger regulatory oversight. So given all of that, allowing them to convert into banks is, I think, a good idea.
Rashesh, there is considerable consternation on allowing for large business houses to enter the banking space. This is historical consternation from both within the RBI, and several experts outside also believe that the RBI's supervisory functions are not necessarily up to speed in being able to ensure that there would be less conflict or minimal conflict in such situations. And especially with what we've seen in the recent past, with what's happened with IL&FS, or what's happened with, DHFL, it does seem as if allowing for large business houses could create several more problems. Do you think that's a hurdle that can be overcome in a short period of time, let's say 3, 4, 5 years? Or do you think that's something that will continue to be a problem and the pushback will be too hard?
I think first of all, using the supervisory capacity as a constraint should not be a starting point, because I think all institutions have to build their supervisory capacity, and RBI has done a great job over the years. The same held true when you introduce private sector banks. The same when you introduce small finance banks. The same also is true with NBFCs, because RBI is the oversight, the regulatory oversight on NBFCs, especially the systematically important NBFCs, has also ensured that RBI had to increase their supervisory capacity. So I think that we should take it as a given. If your economy is growing, and if your economy is going to grow from $3 trillion to $5 trillion, every regulator in financial services will have to increase the supervisory capacity. So let's take that as a given. I would say a lot of the corporate houses are already in insurance industry, they're already NBFCs, they're already in the mutual fund industry, where also they're channelizing household savings into long-term investments. So if you have allowed corporate houses into insurance, into mutual fund, into NBFCs also, in a way they're already part of the financial ecosystem. I think banking is just one more step in that direction. Banking is slightly more intense from a consideration point of view, because, as you said, it involves customer deposits, but so does, in a way, mutual funds. So does NBFCs who do bond issues. So do insurance companies. It's the same, and I think we have had a lot of these large corporate houses have been in this businesses of insurance, NBFC, and mutual fund for a long time, and they've done a fairly good job. So I think on the whole, ownership structure has not been a determinant of governance. Governance lapses can happen in any structure, and it's high time maybe we realize that. So I think it is a good thing. And as I said earlier, this was not always there. This was only in the last 10, 15 years that RBI said that industrial houses or corporate houses into banks is not a good idea, because 25 years ago it was not a constraint.
Fair enough. We could argue this forever, but I'll leave this point here. Let me come back to the point of NBFCs wanting to convert. So those that belong to large corporate houses were obviously not welcome, but the on-tap banking license has been available now for a couple of years, and yet we haven't seen much enthusiasm for it. Do you think in this particular case, if these recommendations were to become reality, that there would be many NBFCs who in the last 2 years might have changed their minds? For instance, let me give you an illustration. I think Bajaj Finance in the last couple of years has expressed that it may not be very keen to get a banking license, and for reasons the various capital requirements, etc., etc. So, do you think there might be many NBFCs that might actually want to convert into a private bank?
So I think the biggest constraint was allowing corporate houses to be in banks, because larger NBFCs, NBFCs which are more than, say, 50, 60,000 crores of assets, are all corporate houses, because even to be a large NBFC, you needed borrowing capacity from banks and bond market and all. So even firms like ours, which are not part of a business house, our NBFC is about 20, 25,000 crores after 10, 15 years of existence. So in order to build a large NBFC, you needed to be having access to capital and liquidity, which the larger houses have it. So that was the first constraint. So I think allowing corporate houses to be a bank allowed the larger guys to do that. Also, if you do the analysis of the pros and cons of banking versus NBFC, and that's, I think, the heart of what you're asking,
Yes.
What are the pros and cons of being a bank versus an NBFC? And there are clear pros and cons, and they change over time. I think last 2 years, being an NBFC had its own cons, which got highlighted a lot more. But over the years, we have seen that there are definite advantages of both, and I believe they both need to coexist. I think as a general rule of thumb, the problem with either banking or NBFC is not the opportunity to lend, the opportunity to build assets. It is a liability challenge. And what has been that on the liability side, once you cross 50,000 to 100,000 crores of assets, you become too large to be able to just roll over your debt in the wholesale markets every, a third every year. It becomes too bulky, too cumbersome. And in a bad year where something like ILFS happens, if the markets freeze up, then the rollovers become either hard to get or very expensive and can pose a clear systemic risk. As a result of that, I think after a certain size, being a bank does give you liability stability, though there are more constraints on what you can do on the asset side. So the way to think about it is, I think one is to think about it as size. I think if you are, say, crudely, if you are below 30, 40, 50,000 crores, the advantage of being an NBFC vis-a-vis being a bank. After a certain size, the advantage of being a bank. The other way of looking at it, in a bank, there are restrictions on what you can do in terms of the asset side, the loans you can give, and the priority sector and all that. But you have a lot more stability on the liability side. As an NBFC, you have a lot of constraints on the liability side, but you have a lot of freedom on the asset side. So I think at a smaller scale, NBFCs will have certain advantages. At a larger scale, NBFCs, banks will have certain advantages. Also, there are a lot of other nuances. Bank can sell transaction services and the foreign exchange and all of that to make other money, credit cards and all that. So I think there are advantages of cross-sale, of size, of liability, of asset side freedom for both of the models. And if you look at the performance of NBFCs or the banks, I think most good banks make, say, 2 to 2.5% ROA. Most good NBFCs make 2 to 3% ROA. A lot of the bad banks make hardly any ROA. A lot of the bad NBFCs also hardly make any ROA. So in a way, I don't think if you look at the actual universe of banks and NBFCs, the profitability has been almost in the same spectrum in that sense. I think the more determinant will be size, strategy, all of that.
So on a consolidated basis, would you all be eligible? How do you read into these recommendations? And would you all then at Edelweiss be interested in a banking license? And if not, why?
As I said earlier, we are very small. I mean, everybody thinks we are very large in the credit space. If you look at Edelweiss, we are more a diversified group. So if you look at our total assets in advice, in ARC, in wealth management, in asset management, we are closer to 3 lakh crores. But our NBFC assets are about only 25,000 crores. So we are much smaller. In fact, we have always been a very small NBFC. So in the last, I think, few years, that part of the business got highlighted. So we have 8 businesses in Edelweiss, from insurance to asset management to wealth management to ARC to housing finance to NBFC. So for us, I think we are still very small. We are still a lot farther away. And I think the next 5-7 years, we have a very good plan on what all we can do on NBFC model itself. And as I said, being a bank is also very capital intensive. And we are, as you know, a first generation entrepreneur company. The one thing we don't have in access is always capital. We have raised quite a bit of capital. We started Edelweiss 25 years ago. In fact, we just finished our 25 years with equity capital of 1 crore rupees. We now have an equity capital base of 8,500 crores. But this is split across all the businesses, our ARC business, our life insurance business, our general insurance business, asset management, wealth management, etc. And I do feel that there are a lot of opportunities for firms like ours in credit, but as an asset manager. So in the last few years, we have raised a lot of funds. We have close to 30,000 crores in credit funds that we have raised from international investors. And we also have on the mutual fund side, the Bharat Bond ETF and all that we have raised. So we think ultimately credit will have, various opportunities as a bank, as an NBFC, as a housing finance company, even as an asset manager, as a fund. And we would rather do it as an asset manager. That has been our stated strategy, because that doesn't require a lot of capital and that doesn't have an ALM risk. Because in India, I think whether you are a bank or an NBFC, the larger problem has not been credit risk. Credit risk, you can price it in, your underwriting standards can become stronger, all of that. Instead of 2% NPA, you might end up with 4-5% NPA. It hurts your earnings, but it won't kill you. But ALM risk is a big one. If you have to pay somebody 100 crores and you can arrange only 99 crore and you can't arrange that extra 1 crore, you still default. So I think ALM risk is a bigger one, and we've been very careful about that. So even in last many years, we hold a lot of liquidity. We make sure that we are always well capitalized. So for us, I think it's more important to make sure from a capital efficiency point of view, an asset management model for the same credit opportunity is important. And I must say that the credit markets in India are changing a lot. And if I may just step back, if you go back, say 30, 40 years ago, all credit in the economy came from the PSU banks. And then about 25 years ago, we started private sector banks. So it became the PSU banks and the private sector banks. There have always been a few international banks, but they've been small players. Then about 20 years ago, NBFCs started growing. So that was the third market. Then we have at the bond market. Now we have the fund and the AIF market. And I think all these have different levels of risk return, ALM kind of approach to take. And the Indian economy needs that. It's the same thing happened in equity markets 25 years ago. We started mutual funds, we have public equity, then private equity has come in, now REITs and InvITs and all have come in. So I think the way there is a multiplicity in equity markets that happened over the last 25 years. I think the last 2 years of the credit market crisis and the slowdown and all that has made it imperative that we really expand the range of product portfolios in the credit market also. And hence thinking only NBFC or only housing finance or only bank or only fund may not be enough. I think there are multiple opportunities. And we as Edelweiss, to give a short answer to your question, we have Edelweiss are focused a lot more in building credit-related asset management products.
Okay, so I'll come back to that in just a bit. A couple of quick reactions, though, on some of the working group recommendations. I think one is shortening the timelines for payments banks to convert into small finance banks. We have, I think, about 6 payments banks operational in India right now. And some of these might actually see an advantage in converting to small finance banks, according to you. That just adds to, like you said, the multiplicity of service providers in the industry.
Absolutely. I think the payment banks were earlier envisaged as pure transaction-oriented banks. Right. And maybe 5-7 years ago, there was an opportunity in that. But the way the telecom industry and the payment space has got disrupted, I mean, we have now, UPI and BHIM, and you have obviously all this Amazon Pay and Google Pay. And so given that the payment space has got completely changed in the last 5 years with players like Paytm and all of them being there, I think a pure transaction bank may not have a business model, and that is what we are hearing, that is what we are seeing. So allowing a payment bank to convert into a small finance bank and eventually allowing small finance banks to convert into universal banks, I think gives them a range of options for scaling up and building a viable business model. So I think RBI has been very pragmatic, and I would say that I think all this thinking is actually very good. And I do hope that post the working group report, RBI takes it forward and really examines all these issues.
Okay, the pragmatism has also crept into the NOHFC structure, where again the working group seems to have changed stance a little bit and said that if you don't have other businesses in the group, then you don't necessarily need to adopt this structure. You've spoken to me earlier about how this is not a very market-friendly structure, and hence this might prove to be an advantage for those who actually do want to either are in the banking sector or who would want to enter as well.
Absolutely. I think an NOFC structure has its own needs, but I think we are also making one very big fundamental change. If you read this report and the approach of RBI in the last 5-7 years, earlier the approach was that the bank is a topmost entity and everything is underneath the bank. You can have an insurance company, you can have a mutual fund, you can have even an NBFC, all underneath the bank. So a lot of the older banks that we see have that structure, that there is a parent bank and there are a lot of other financial services businesses underneath that. Now what RBI wants to do is they want to invert this. They want to keep the bank completely insulated at the lowermost, and any other financial services should be held by NOHFC independent. So the insurance company and the mutual fund and all the other financial services related play or the non-financial services related play should all be insulated. Now, this is a good structure from a risk, to ring-fence risk of the bank, because RBI does want the bank not to have any other ancillary associated implicit risk which can be there when you have a lot of other subsidiaries and businesses. But however, in India, this kind of a structure from a market capital raising point of view, NHFCs have not been able to raise capital. In fact, the whole concept of holding company in India is still being debated, and there are large corporate houses which are trying to figure out what should be the value of a holding company in that sense. So I think Indian equity markets have not been friendly to holding company structures and all. So the cost of capital, cost of equity may go up as a result of that for people who have to follow that. And that will also be an important consideration in people setting up banks.
Okay, there are several small issues. Some could be hurdles, some could be, advantages. I won't get into the specifics because this is still a working group, paper. But I do want to ask you, if the broad thrust of this paper were to become reality, Rashesh, how do you see the competitive landscape in financial services changing? Do you see, in the conversion of some of these large corporate house-owned NBFCs converting to banks, a big change in the competitive landscape, a big change for players like you? Do you see some degree of M&A also occurring if some of these doors are open?
Absolutely. I think whenever you have a structural change like this, there will always be a lot of M&A opportunities. Even last time, 25 years ago, when RBI gave the first, private sector banks, a lot of M&A happened after that. And we saw at least for 10 years between 95 till 2005, there was a lot of banking M&A until 2007-8. But after 7-8, there has not been as much M&A as we would have thought. And what is required is constant churn. We need a lot more banks. So it's a very paradoxical situation where you need a lot more banks, but you also want M&A and consolidation in the banking at the same time, because we need a lot more financial inclusion and especially access to credit. Because when we call financial inclusion, it's not just about opening a bank account, it's also ability to get credit. And ability to get credit is still a very small part. So even if about 500 million people in India have a bank account, not more than 40-50 million people have been able to get credit on a regular basis. And we need at least 200-300 million people in India to be able to access credit. So the real financial inclusion in India is not about savings and it's not about investments. It's about credit. And I think a lot more banks will allow us, a lot more NBFCs will allow it. So I think we need a long tail. We need a lot of experimentation is required. Like what happened in telecom in the early days, a lot of telecom companies came in and actually there was no thing like telecom inclusion, but the market forces itself and competition and innovation allowed it to happen. I think we need the same thing in the banking sector. Obviously, innovation will come with certain amount of risks and all that. So a lot of countries have allowed, smaller players and sandbox and new business models and all. But I do believe that credit markets in India need a lot of innovation. If you see the long-term perspective, about 27 years ago, we had this entire equity market crisis with Harsha Mehta and all of that. If you remember, at that time, there was no SEBI, there was no NSE. But I think between 92 to 96, in those 4 years, we got SEBI, we got NSE, we got BSE got automated, we got a lot of the private sector mutual funds coming in, we allowed FIIs to invest in equity markets. And those 5-7 years of reforms, including futures and options, and we used to have a settlement cycle was T plus 30. Now it became T plus 2 gradually. Dematerialization was a big point in that. So on those 5-7 years, equity markets completely got transferred. The market infrastructure, the market mechanics, all of that. And that has actually resulted in 20 years of good growth in the market, equity markets, equity market participation, companies' ability to raise capital. Unfortunately, our credit markets opened up, but opened up a little bit. And every time there was a crisis, there was a feeling that we needed to close it. I think this approach that we have for the next 10 years opening up our credit markets is going to be transformative, because in any economy, equity is so important, but credit is so much more important. Equity impacts only about 40-50 million people, but credit impacts 300-400 million people, if not more. So we need to really uh, expand our credit markets. And along with that, as I said, from NBFCs to banks to funds, we also need a lot more products. We need, interest rate futures. We need credit default swaps. We need repo market for corporate bonds. And a lot of this is known, but I do believe that this could be the post ILFS crisis has been really a good time to think through what do we need to reform the credit market, because we can't have very evolved and constantly growing equity markets while credit markets remain very constrained, because the need of the economy is more credit, and unless credit starts flowing, our growth aspiration will not get met. So I think all this is part of that. I do believe the next 3-4 years there's going to be so much changes in the rules and regulations and the structure of the credit markets in India that agile players will be able to capitalize on the opportunities. There'll be a lot of M&A. There'll be new entrants coming out. There'll be older ones getting consolidated. And we're going to see a fair amount of churn, but it's going to be very exciting, because this is like equity markets from 92 to 98. I think from now to 2025 is going to be credit markets. I hope so. I do think that all the stars are aligned for that.
Oh, well, okay, we won't get ahead of ourselves. This is still a working group paper. And equally, I can understand why you, being in the industry, believe that this can be a very exciting period. But the risk frameworks for equity and for credit are very, very different, Rashesh. And I think there's a lot of trepidation right now on what a dramatic opening up, would mean. But nonetheless, I just want to ask you a sub question on the M&A. What kind of consolidation do you see happening? Can you give me some kind of illustrations on where you see players coming together?
I think one will be NBFCs and banks for sure. And you have seen in the past, a pure housing finance company as an NBFC can grow to a particular stage, and then housing finance companies merging with banks. If you look at most NBFCs in India, have specialized in one or two verticals, either in commercial vehicle financing or in housing finance or in gold loans, which for an NBFC, then it becomes a single product focus and all that. And most of the large NBFCs are focused on one or two vectors. While if you look at a bank will be focused on 18 or 20 credit, credit segment. They will have car loans, commercial vehicle loans, gold loans, home loans, all of that. So I think as a lot of NBFCs will start getting merged with bank, because that product expertise they have will be very useful for the bank. And we saw that when MFIs became banks, and then Group got acquired by Bandhan, all of that. So we will see that banks, in order to expand their product range, and we saw, I think IndusInd Bank acquired a microfinance company a few years ago. So we'll constantly see that. We'll see a start of a lot of the new banks, which will be maybe more technology, maybe hopefully we'll see a pure internet bank also.
Ashish, sorry to interrupt you, but wasn't that possible even so far? I mean, what about these recommendations might enable specific kinds of M&A opportunity?
So it was always there, but banks had so much organic growth, because then there was not, the economy was growing, but the number of banks were not growing. So you could easily organically, and ultimately a lot of M&A, a lot of innovation is done because of competitive reasons. And if there is a lot of competition churn and the competitive pressure, then people start thinking out of the box, and people start thinking, saying, what new I have to do or to maintain my growth rate, what new market segments. Otherwise, I think the economy has a nominal growth of 10-12%. Financial services grow at about 15-18%. It's a lot more autopilot. I think competition does spur a lot of innovation, a lot of cost cutting. I think in all this, I must also mention that India still has one of the highest intermediation costs in the banking sector as compared to anywhere else in the world. And that's why we have a very strange paradoxical situation that people who save money and keep money in the banks feel they are not getting an adequate return. They always feel that they are not keeping up with inflation. People who borrow money from banks constantly feel that it's too expensive and interest rates need to come down. They both can't be true. They can only be true when there is a lot of intermediation cost. And I saw that in capital markets. I saw that you can have very large 2, 3, 4% intermediation cost. But the average intermediation cost should be between 0.5% to 1%. So if a borrower is getting 7%, if a saver is getting 7% and the borrower is getting 8.5, then that intermediation cost is a lot more manageable. India has very high intermediation cost because of credit cost and because of inefficiency and all. And I think this will spur innovation, M&A, all of that. The end game will be not just to get higher growth, but to get more efficiency.
Okay, a couple of quick last questions on where y'all are at Edelweiss. I know you've spoken extensively over the last several quarters now on, the changing sort of framework for credit opportunities for you. You've raised, 990 million recently as well for that side of the business. I was just looking, your loan book has consistently and concertedly come down quite a bit. I think we're now almost a 60% contraction over the same quarter last year, if I was to look at Q2.
On the wholesale book, so we have very deliberately been saying that wholesale credit in an NBFC format is not very efficient, not because of credit cost, but because of ALM risk. Because wholesale is always going to be chunky and all. You make money for 3 years, then you will impairment for 2 years. In an NBFC format, where every quarter you're getting audited and all that, it's not a good, because a lot of this is project finance. So whether it's project financing, infrastructure financing, a lot of development funding coming from NBFCs or banks is not as efficient because of the the uncertainties around that. But in a fund structure, they can be very efficient. So what we have learned in the last 8-10 years is that wholesale credit should ideally be in a fund, a closed-ended fund structure, while NBFC model is more for retail. So what we are doing is growing a retail business, a housing finance business, and a retail, which was smaller because we started 14, 15 years ago as a wholesale credit NBFC. We are bringing a wholesale credit down, but instead of not doing the business, we are doing that in an asset management format. So to give you an idea, at peak, our wholesale credit book was about 18,000 crore. The funds we manage now are equal to 30,000 crore on same wholesale credit strategy. So same strategy, but in different format. Because as I said, the problem is not with the strategy. The problem is with the liability available for that. Because if the Indian market, as I said, for liabilities getting chunky, and you can always, the approach in India was that a quarter or 2 quarters of uncertain liability you can manage. But now we have seen 2 years where the liability markets, the bond markets and the other wholesale markets have been dislocated. And in that kind of an environment, if you're part of a large corporate house, you have some fallback, you have some backstop. But otherwise, for a pure NBFC, which is not part of a corporate house, the ALM risk becomes very high. And hence, either you incur a lot of cost in managing liquidity, which is what we have done. We hold about 3 times the liquidity we used to normally hold. And that liquidity holding is also a cost because that is not earning much for you. So given all of that, your economics undergo a change, all of that in an NBFC format. So we are transferring or transforming that business into a asset management format. Our NBFC will continue to grow on the retail side, but a retail book out of NBFC is still much smaller. It's only about 5,000 crores. Right. So we have a lot of growth opportunity. We have a lot of equity capital in that. We have almost 1,500 crores of equity in the retail credit business and 3,000 crores of equity in the wholesale credit business. So we have a lot of equity. If we can reduce wholesale, free up that equity, use that equity for retail growth, it could be a good strategy for a player like us.
So is there a target you're working with in terms of the loan book size on the NBFC or traditional lending front, whether it's a reduced wholesale book, and then of course a lot more in housing finance and other retail credit, and then the kind of asset size that you're looking to manage through the credit opportunity front?
Yeah, so on the credit opportunity fund, we are now raising about $1 billion to $2 billion a year. So if you see 2 years ago, we raised 1.3 billion, 10,000 crore stressed credit fund. Right. Then last year we did an infra credit fund. But this year we have done a special opportunities fund. We are planning to do a real estate credit fund. And all these funds will aim to make between 14 to 20% kind of return. So what I envisage is there'll be a bond market where the returns will be about 8-9%. There'll be a bank market where the yields will be between 10 to 12%. There'll be an NBFC market which will be say 11 to 13, 14%, and there'll be a 14 and above market which will become like a fund market, because in those kind of strategies, you need long-term flexible capital, long-term holding power, no ALM risk, all of that. But it gives higher return because of that. So I think that is how the market will evolve. The bond market, the bank market, the NBFC market, and the fund market, and they all will coexist in their own way. They will all, like the bond market will be very liquid, while the fund market will be a close-ended market, so will not be as liquid. But you will have institutional qualified investors, the pension funds and the insurance companies who invest in that. So we do believe that our credit funds, we can go to almost $10 billion and all in the next 4-5 years. We will raise about $1 billion, $2 billion every year. That is what we've been doing even in the last 2 years of crisis. We had about 18,000 crores on the wholesale NBFC, which has now come down to 8,000, as you very, very correctly said. That is what we have shrunk. Our long-term target on that is to take it away, to make it zero, so that all wholesale strategies are asset management. There is no NBFC wholesale at all. Our retail book is fairly small, only 5,000 crore, that we think we can double in the next 3 years. So NBFC retail, asset management wholesale. A very crude and simple way of looking at it.
Okay, great. Thanks. One last question then, and this is the, sort of, how aware do you see the economy right now? I think we've, come out a couple of months from the moratorium period. When it comes to bank loan restructuring, the broad feedback seems to be that many companies are not keen right now to go through that. None of this is giving us a completely clear read on the stress in the economy. There are a lot of different varying data points. What are you focused on? What's telling you about the reality of this economy at this point?
So I think 3-4 points. I think first we should acknowledge that the panic that was there. I remember, I think from March, April till about August, there was a sense of crisis. There was panic, not just in the banking sector, overall for the economy, because we didn't know what was in store. We didn't know the impact of COVID, all of that. But I think post-August, there's been a clear improvement in the business sentiment. The sense of panic has gone away. I do feel the crisis has gone away. Economy has bounced back. Global liquidity is very benign. Indian liquidity has been, RBI and government have done a lot of things to make sure that the crisis has been abated. So what was a crisis has gone away. Now we have a growth challenge ahead of us, and a lot of things RBI and government are doing. So in a way, first I would say the crisis has been converted into a challenge, which is a good thing, because you don't want to be trying to grow when there is a crisis that could be brewing. So I think we have got that behind us. That is one big relief. Economy has bounced back fairly well. The activity we are seeing on the ground in terms of cars and two-wheelers and home
But
sales.
is it all this pent-up demand? How does one gauge whether this is sustainable or not? What are you looking at in terms of figures?
It's always going to be complex, because there will be part of pent-up, but part of it is also, I think there was a lot of demand slowdown that was there for last 3-4 years. So there is a 3-4 years of pent-up also that is there. But along with that, I would say, I think the customer behavior on the credit side also has been very good. Collections have improved consistently, partly RBI's liquidity injection, partly government schemes like the MSME Atmanirbhar Bharat scheme. So what you see on the demand side is pent up. On this side, you see all the specialized schemes which are there. So you are very correctly asking what happens when the pent up demand is over, when the specialized schemes are over. I think we'll just have to wait and watch. The indications we are seeing is there is going to be credit cost for banks and NBFCs. There is going to be impairment over and above the ordinary one. So the way to look at it is, I think most banks and NBFCs have between 1 to 2% of their assets as normal credit cost every year. So if you have a 100 crore portfolio, your credit cost will end up being between 1 to 2 crore every year. Housing finance is lower, but normal NBFCs and banks are in that range. I think that will double for the next 2 years. So we are expecting most banks and most NBFCs to have, say, approximately between 1 to 2%, say approximately 1.5% of their assets as additional credit cost per year for the next 2 years. So say about 3% of their assets. So if a bank has, say, 1 lakh crores of assets, the bank should expect about 3,000 crores of additional impairment over 2 years. And ironically or interestingly, most banks have raised capital. And if you look at the capital raise that banks have done, have been between 2 to 4% of their assets. So if there was a bank with a 5 lakh crore asset, that bank has raised about 10 to 12,000 crores of equity capital. So I think equity buffers have got built up. I think given what the cleanup that we've seen on NPAs in the last 4-5 years, I don't think we'll see that kind of level again. I think we should prepare ourselves for 1 to 1.5% of assets as additional impairment or credit cost for the next 2 years, which is okay. It will hurt earnings a little bit, but I think the capital buffers are there. People are prepared for it. So it won't be a shock to the system. It won't be bad news. And I think I've always found that if people are prepared, it's a lot easier to absorb the reality, because ultimately I think reaction is always a function of expectations versus reality. So I think people are expecting it. So it can only be pleasant surprise if it's lower. I don't think there'll be too much shock to the system going forward.
All right, Rashesh. I guess, the next 2 quarters of this financial year will give us a better read. We're all trying to make sense of the data. But thank you so much for your insights this morning, both into the working group recommendations, as well as how you see the financial services industry and the economy panning out over the short to medium term. Thanks very much for speaking to BloombergQuint.
Thank you.